Let's now get into the advisory and common mistakes to avoid when investing in volatile markets. Well, we're in that situation right now, given the volatility we're seeing across all markets at the moment. Glen Hare is joining us from Fox and Hare Financial Advice. Glen, welcome back. Good to see you at AusBiz. Volatility is the name of the game, all based on this uncertainty that is ruling markets at the moment. What do you need to consider then in such times?
Yeah, thanks for having me, Andrew. So, good question, and you're right. Like since the beginning of the calendar year, it's been, a turbulent time for markets. Even looking over the last 12 months, the last, 4 weeks or the last month, S&P 500 down 8%, the Aussie market's down 8%. So, the first thing that we want to be avoiding is making impulse investment decisions based on market fluctuations or emotional reactions. Timing the market is notoriously difficult, and emotional decisions can lead to poor investment outcomes. So, having that really clear, sound investment plan and sticking to it, regardless of short-term market volatility, is the first of the three things that we want to make sure that we avoid. With the market dropping off, there's a conversation that's often had around making sure that if the market does drop off, we stay the course. We don't sell out at the potential bottom of the market, so that we're then just sitting in cash and the market recovers and we're still sitting there with our pot of cash and our high interest savings account, missing out on that rebound. Something that I don't think gets enough airplay, Andrew, is ensuring that we're sticking to a sound investment plan when markets go down, so that we are buying in at those lower price points, right? Like if we spent 2024 buying in as things were getting more and more expensive, but then we stop investing in 2025 because we're worried about that volatility, then arguably we've missed out on buying some value stock at lower price points. So staying the course is the first certain recommendation, and we want to avoid those impulse decisions.
It's interesting, in fact, Glen, because just over the past week or so, speaking to a variety of investors and fundies and the like, some opting to stay fully invested, others opting to go 100% cash. It's like diametrically opposed. And then I guess you got to consider, well, you talk about timing, the difficulty of that, of whether you try to pick the bottom, how you actually get back into the market if you've sold out. I mean, it's a variety of decisions to make, none of them easy.
No, and it's a good point. And there's no one size fits all, right? Like the way that we determine whether a member should be in cash or whether a member should be fully invested is actually understanding what it is that we're actually investing for. So, if your goal is to purchase a property in the next, 3 to 6 months, then you're probably going to be wanting to sit mostly in cash because you're going to need that to put forward for the deposit. Whereas if we're thinking about building longer term wealth, generating a future passive income, then arguably we want to be taking advantage of the downturn and potentially looking at making larger investments when these opportunities present themselves. In saying that, though, the caveat being is we've got to understand our, tolerance and comfort level associated with risk. And if we are looking to remain fully invested, we've got to make sure that, the household kind of finances allow for that. We've got a good cash buffer. We've got relative job security and the like.
And Glen, you talk about the importance of diversification then, or a problem that people run into is exactly the opposite, that they're not diversified enough.
Correct. And that, it really draws on your comment earlier, Andrew, around making sure that, yes, we do have an element of our overall household wealth sitting in cash for kind of those short-term needs, but for future, again, wealth creation, generating that future passive income, we want to be looking at growth style investments. Whether that be Australian international shares, looking at different industry sectors, looking at also just geographical location as well. So lack of diversification can certainly lead to issues and problems, and even thinking about those where they're working with companies that provide a lot of their remuneration in employee stock, whether that be through employee share option plans, restricted stock units, things like that. What we can end up with is a lot of our wealth sitting in one particular stock, because that's formed part of our remuneration over the preceding years. So we want to be thinking about that diversification piece. The third mistake, which again I don't think gets spoken about enough when we talk about investing and investing in property or markets or anything more broadly, is the tax implications of our investment strategy. It's really interesting when working with a couple. What I'll often find is, and this is a broad generalization, but it's the higher income earner that often is interested in investing, or they're having a crack at putting a portion of their income into the stock market. But if they're doing it in their name, then at a household level, they're going to get taxed more than their partner is. And it's no different to having savings in a bank account, right? Like, people often forget about the tax implications of simply just receiving interest on a high interest savings account. If you're in a relationship where you put those savings in your partner's name at a household level, you're going to be paying less tax, given that it'll be taxed at your marginal tax rate. And we should be thinking about things like investment bonds, which cap the amount of tax that we have to pay, certainly for high income earners. And when we look to sell out of that investment, if we've held those investments for a period, we can liquidate capital gains tax free. Thinking about trusts and the flexibility that trusts have when again managing our tax obligations. So yes, we need to make sure that we're investing for future wealth creation, but we also need to make sure that we understand the tax implications, acknowledging that every single investment decision that you do make is going to have tax implications, for better or worse.
It leads me to my next question, Glenn. As when you approach the end of the financial year, you'll often see tax loss selling there.
Yep.
How important is it for an investor, I guess, to accept perhaps an investment hasn't worked and you need to cut your losses?
Very. Otherwise, if your investment is going backwards and you sell out of that portfolio or sell out of that particular investment and redeploy that into an asset that's going to more than likely generate a greater return over the long term, that is something that needs to be done. And this is where we need to be taking emotion out of our investment decisions. If you're bought an investment property and it hasn't done well and it's just kind of sat there over the last 5 years and gone sideways, then we need to be thinking about, well, I'm paying all of this interest on my mortgage, or and that capital that I've got there is just sitting there not going anywhere. Then we should be liquidating. We should be looking at alternatives. And the timing, and picking up on your comment there, Andrew, the timing of when we make these adjustments, reflecting on volatile markets at the moment, is really important. So a really obvious example. I was having a chat with one of our members last week, and she's about to go on maternity leave. So there's going to be a period where her income is going to be less than it would be in previous years. And that gives us an opportunity to then readjust her portfolio, noting that there are going to be some capital gains as a result of that. But the tax implication is going to be certainly significantly less, because it's likely that her assessable income while she's on maternity leave is going to be less. So timing is critical when we're thinking about making adjustments to portfolios, particularly when it comes to tax.